ETF investing is awesome. I love it, been doing it for many years, and I think it's one of the easiest ways to passively grow your wealth over time. When we invest into an ETF, we actually want to follow and mimic a certain index, such as the very popular S&P 500, for example, the 500 largest companies in the US. There are other indexes out there as well, but that's one of the popular ones that many people like to invest into. So while we cannot invest directly into an index such as the S&P 500, we can invest into an ETF that is provided by an ETF provider such as Vanguard, BlackRock, or State Street, some of the bigger ones in the world, and they, on your behalf, invest into that index through the ETF. So in an ideal world, that ETF would mimic the index one-to-one, meaning it would absolutely follow the index 100%. However, there is no ideal world, and sadly, that is not the case. They're getting pretty close to 100%, but nobody is managing to be exactly 100%. And that's called tracking error or tracking deviation, and basically talks about how much the ETF is deviating from the actual performance of the index. If it gets a little bit complicated, don't worry, I'll try to simplify it as much as possible, have also a graphic prepared for you so you can kind of get the idea. But I think it's very important to understand the concept, especially if you plan to invest into ETFs in the long term. Now, first off, let's see what the actual technical definition of a tracking error is. And who better to say that than Vanguard themselves, one of the leading ETF providers out there. And as they say over here, tracking error is measured as a standard deviation of excess returns over time. It's an indicator of how consistently close or wide an index ETF performance is relative to the benchmark. Now, basically, it means how much it is either up or down from the index. All right, let's try to visualize it. And please don't laugh at my drawing. I'm not really the best at that. I'm just trying to convey the point over here. So let's imagine this is the S&P 500 chart over time, which generally kind of grows over time, right? So let's imagine that's the growth over the last, 20, 30 years. Now, as I said, in an ideal world, that chart would be exactly the same as the ETF chart, right? It would just follow exactly the same growth line or exponential growth, whatever it will be exactly identical line. However, that's just not possible in real life, and I'll come to this in a moment. The reality of it is that actually it usually underperforms a little bit, but there might also be a period when it's a little bit up and then some other period a little bit down. So basically along the line, it kind of goes up and down or stays down for a longer period. So generally it rather underperforms than overperforms. We speak about very small deviations, but again, those can add up over time. I'll come to this later on when I show you real numbers. But yeah, this is basically the principle of tracking error, because it's just not possible for any ETF to 100% replicate an index. And that actually gets more and more difficult the more stocks you include. Here we talk about 500 biggest companies in the US. Now imagine if you talk about, for example, the FTSE All World, which I believe has 3,800 companies and spread out across many different countries globally, obviously, as the name implies, that tracking error will get even higher. It's just harder to follow all those different companies and indices across different parts of the world. So that's definitely something very important to keep in mind when you make a decision as to which ETF you're going to buy. But let's talk about some of the causes for tracking errors. Now, the first one, sampling. Sampling basically means the way the ETF is buying and holding the shares on your behalf. There are different methods out there. Two of the most popular ones is either physical replication, which basically means the ETF provider is really buying and selling those shares on your behalf and really trading them physically, basically like you and I would do if we buy them through a stockbroker. Or there's sampling, which is quite common, especially again for global ETFs. If they had to buy all these shares in smaller countries around the world, it would be very expensive and time consuming. That's why a lot of ETFs do different ways of sampling. Each ETF provider has a different way and method behind it. But basically, that's a difference of how they replicate and own the shares, sell the shares. That already causes a little bit of a difference between the different ETF providers. Another one, of course, has to do with the rebalancing frequency, right? An index is nothing else than different companies moving up and down, depending on their weighting. Some move up, some move down, and that's very dynamic, right? The markets are open 5 days a week and constantly trading, and some companies are going up in value, some going down. So there's constant rebalancing happening. So in order for the ETF provider to catch up, they have to also frequently rebalance their own portfolio, right? Buy and sell depending on how things are going. If Nvidia in one day goes up, let's say 10%, right? That will bring a huge change to the S&P 500 overall outlook and returns, right? So then immediately the ETFs need to react and make their adjustments accordingly and rebalance their holdings to mimic the S&P 500. So that's just something to keep in mind. And obviously the more frequently they do it, the closer they are aligned. Imagine if they would only rebalance once a month, which of course no ETF is doing, eventually they would obviously be way off the actual index, because the index is trading constantly. If they only traded once a month, you might have some major bumps in here and much bigger deviations like that. So the more frequent a particular ETF is trading, the more closely they are aligned. The same with cash drag, right? How fast and in what way they're dealing with their cash reserves definitely also impacts the tracking error. Dividend reinvesting, in case you have an accumulating ETF, how quickly are they reinvesting the dividends? And lastly, fees and expenses. That's arguably one of the biggest impactor of tracking error. That's basically the fee that the management companies, in this case BlackRock or Vanguard or State Street, is taking out of your returns in order for them to manage all that process that goes into mimicking the index, right? So that's a lot of work involved and a lot of people involved. They need to be paid. And usually those fees are very little. You know, in my case, I pay now 0.03%, but there are also some ETFs that can cost up to 1%, which is a little bit ludicrous, to be honest. Please don't pay 1% for passively managed fund. That's way too expensive. But yeah, those things do make a difference. If there was a scenario when ETF would be 100% matching the index 1-to-1, so let's say after 1 year, the S&P 500 returned exactly 10% and the ETF exactly returned you 10%. That would be awesome, wouldn't it? However, imagine your ETF provider, as I said, Vanguard or BlackRock, would charge you 0.1% fee for managing it. Your return would not be 10%, but 9.9%. So that obviously goes out of your returns that you get an investor. You don't really pay it. They just take it out immediately out of the return, keep it for themselves, and pay you in a way the difference. So you can see already the impact those expense ratios lead to the biggest deviation across the different ETF returns and tracking errors. And just to reiterate the point, fund management and trading fees are often cited as the largest contributor towards tracking error. And I find this chart quite interesting to visualize it once again. Here you have, for example, different S&P 500 ETFs based in the US. So these are not UCITS ETFs, they're actually based in the US. But yeah, still visualizes, the growth of $10,000 invested over time, what it would lead to. I don't know the time period, it's probably 1 year, I suppose. But yeah, you could see more or less similar, right? There's small deviations, but more or less similar. But then when you really zone in, you can see the two different funds and the tracking difference annualized over time. Because some funds buy and sell at different intervals, that definitely in between that period, there are some ups and downs between them. So you can really see it does make a difference. It is just not possible to perfectly track an index because you're always reacting to what the index is doing. So you're always one step behind, right? The idea is to minimize that behind as much as possible, but you're always going to be one step behind. And then how you rebalance yourself, how you minimize your expense ratios, what have you. So yeah, all these things lead to a tracking error. And the idea is, of course, to minimize it as much as possible to have the highest possible returns for the investor. And that's why when we select our ETF to invest in, there's so many different aspects to consider, right? First of all, we want to choose what the ETF is mimicking. Is it an index? Is it a different asset class, an industry? Then of course there's a question, is it distributing? Is it accumulating? Which kind of currency? Total expense ratio? So definitely many factors to consider. However, recently myself actually, I chose my ETF of choice as I previously used to invest into the S&P 500 ETF from Vanguard, VUSA, one of the most popular ones in Europe, and I always enjoyed it. However, I noticed that their expense ratio is actually quite high at 0.07%. And I found a much cheaper, in fact, the cheapest S&P 500 ETF for anyone outside the US. And that was from State Street. So when we head over to justetf.com, you see over here the cheapest S&P 500 ETF UCITS. That's for basically non-Americans. We can buy those. You can see that's the ETF that I bought, because it has a very low expense ratio of 0.03%, which is unbeatable. However, recently I actually got a really smart comment under one of my videos from one of the subscribers, which I really appreciate. Always love hearing from you guys. And that person actually had a very valid point. Just because an ETF is the cheapest in terms of expense ratio doesn't necessarily mean it has the highest returns, because once again, we have to look at the tracking error. It's one component of it, but it's not the only component. So that's really something to consider. Look at the total returns, because usually tracking errors are not highlighted. There's not a database that you can look for tracking errors, right? Usually those companies want to cover them up and don't showcase them. So it's really hard to really find that. At least I haven't found a good resource for that. If you do know any, let me know. But usually the best way is you look at the total return. You compare it, for example, to the index directly, or you compare the various ETFs over a longer time period, which of them actually performed the best. And based on that, you can make your own decision. So coming back to just ETF, in this case, we saw that the SPDR, SPY 5, the one I'm buying, is the cheapest. However, when we look at the best in terms of performance, meaning that it most closely resembles the actual S&P 500, let's click into this and see the differences over there. Now here you have all of those, but in my case, I want to buy distributing ETF. The choice is yours. Some people like accumulating, some distributing. Depends on many factors. There's no right or wrong. If there was only one right, everybody would be investing into the same. So it has many different facets to it, and I can make a whole video about this topic if you want in the future. Let me know in the comments below. But yeah, basically I want distributing and I want full replication, because I don't like swap-based. Again, in case something happens, I want to make sure that my ETF provider of choice actually owns those shares. And then we go up. Actually, we don't have that many ETFs left to choose from. And all of a sudden, my beloved SPDR ETF that I bought is no longer the best performing. You can see here in terms of total performance over 1 year, actually not that well. All of a sudden, we have another one at the top here, which is HSBC S&P 500. Let's go over to periods to have an even longer period of up to 3 years. Now, all of a sudden, we have the iShares at the top, which is from BlackRock. And then we have the Vanguard number 2. And the one I bought is only number 4. You can see here quite a bit of deviation in terms of total percentages. While the first one returned 49.64, mine in this case only returned 49.43. So that just shows you cheapest is not necessarily the best, right? We want to look at total returns, total performance of your ETF. So that number is very important. So looking at this, in my case, you would think, Guy, you should be selling right now your State Street ETF and buy iShares because it performed the best over the last 3 years, as we just saw, right? And yes, I could do that. Probably all of those options I've shown you are great options. I mean, let's be honest, in the end, those little percentages are really small differences, right? If we look at other indexes, those differences really start adding up. But because the S&P 500 is one of the most traded index in the world, generally all ETFs are really doing a good job. However, still, I like to get the most out of my money, right? So in that way, I should be investing. However, having said that, State Street only recently actually cut the expense ratio. As you can see in this article over here, it's only been effective from 1st of November last year, 2023, that they lowered the expense ratio, which was previously 0.09% and now 0.03%. And as we saw before, that has a huge impact on the overall returns, right? And as they previously used to be more expensive than the Vanguard or BlackRock, both of which are at 0.07, naturally, that also had an impact on their returns. And when we head over to Morningstar, here we can really compare the performance against each other. Again, you cannot specifically look for tracking error, but you can look at total returns of those particular ETFs. In this case, I'm comparing the S&P 500 from Vanguard, State Street, and BlackRock. I'm investing in US dollars and it's London-based, so again, your numbers might look a little bit different if you invest in Europe in euros, but the principle is the same, right? I'm really comparing apple to apple. And over a 5-year period, once again, you can see here the SPY 5, which is the one I'm buying, the cheapest I just showed you, underperformed, only returned 75.83%, while the other two returned over 76%. So already quite a deviation. If I go out even longer, the difference becomes even bigger. In this case, funnily enough, actually SPY outperformed the Vanguard by 1 percentage point, but then the BlackRock ETF surprisingly outperformed even higher. So actually well done over there. I'm not sure why there's such a difference. Usually it's 1-2%. So yeah, over a longer period, that is around 12 years from now, they did very well. That's quite interesting. However, for me also interesting, as I just recently opened a position in State Street, let's go to year to date. And here, surprise, you will see that State Street is actually performing the best so far. Obviously, it's been only a couple of months. That's why the numbers are also smaller and deviation is smaller. But still, when I look at that, that actually gives me confidence that State Street, after all, is still very, very competitive with the other two players. In fact, I do believe it comes back to the point I made earlier that expense ratio does have a huge impact. And as I just shown you before, they only recently lowered it from 0.09 to 0.03. That's why over a 5 or 12-year period, the impact is not really there because that's only 3 months out of many, many years, right? But now, when we really look apple to apple, year to date, since the beginning of the year, in which case already the expense ratio was lowered, we can see they start to perform better because the expense ratio does have an impact. So for me, that's really reassuring to see, and hopefully that will continue. And I think it will actually, unless the other two ETFs eventually will lower the expense ratio. But I believe if they don't, long term, the State Street ETF can actually outperform those two. But of course, only time will tell. And this just shows me once again, there's no right or wrong in investing. Well, granted, there's many wrongs, but there are also many rights. I believe if you invest into S&P 500, as I said, any of those three, you'll be in very good hands. I mean, we're talking about tiny, tiny differences over time. But something you want to keep in mind, if you invest into global ETFs or more industry-specific ETFs, let's say an AI technology ETF or an ESG-specific ETF, then definitely those tracking errors can really add up beyond just expense ratio. So I really urge you to look at total returns of your chosen ETF over a long period, in addition to looking at things such as expense ratio. Liquidity is another very important point, because obviously if everything adds up nicely, but the fund doesn't really have much investment, people trusting that particular ETF with their money, eventually the ETF provider may decide to close it down, and then you have to pull out your money, invest it elsewhere. So you want to have also a very popular and liquid ETF. So many different aspects to it, but I do hope that this video was insightful. You learned something new and actually apply it in your ETF making decisions. Next up, check out this video over here. As always, thanks a lot for watching. Stay healthy, get wealthy, and I'll see you in the next one. Ciao.